The market knew yesterday. You found out today. That's not a metaphor. That's how the system is designed. Last night, while you were asleep, billions of dollars moved across screens you will never see. Prices shifted. Bets were placed. Quiet decisions were made in rooms without windows. By morning, you woke up to headlines that felt sudden. To markets, nothing about it was sudden. Here's the uncomfortable truth. Financial markets don't react to the future. They price it in before it happens. And that power shapes your life. Gas prices, mortgage rates, job security, the value of your savings, even the stability of your country. All of it sits downstream from a machine that sees before you do. Imagine two people standing on a hill. One person is you, looking at the city, traffic, lights, weather, what you can see. The other person is inside a control tower with satellite feeds, sensors, and real-time data from thousands of places at once. When a storm forms miles away, you notice the clouds. They see the data hours earlier. Markets are that tower, but not because they're wise, because they are fast, connected, and brutally incentivized. This is why this matters right now. We live in an era of permanent uncertainty. Wars, elections, climate shocks, supply chain breakdowns, AI, debt, fragile banks. In this world, whoever sees first wins. Whoever sees last pays. And most people are always last. So how does the system actually work? Start with a simple idea. A price is a prediction. When you see a stock at $100, that number isn't just what it's worth today. It's a collective bet about what it will be worth tomorrow, next month, and next year. Thousands of traders, funds, and algorithms are constantly asking the same question. What will happen next, and how do I make money from it? They don't wait for reality. They move ahead of it. Here's step one. Information flows. Big financial players pay millions for data you will never get. Shipping logs, credit card transactions, satellite images of parking lots, smartphone movement patterns, supply chain tracking, insider whispers that are technically legal. By the time you read a news article, they've already acted. Step two. Expectations shape prices. If traders expect a war, oil prices rise before the first missile. If they expect a recession, stocks fall before layoffs appear. If they expect inflation, bond markets move before grocery prices jump. The future arrives in prices first. Only later does it arrive in real life. Step 3. Leverage magnifies everything. Traders don't just use their own money. They borrow, sometimes 10 times, sometimes 100 times what they have. A small belief about the future can move trillions. That's why markets can feel like prophecy. They are betting machines powered by borrowed money. Step 4. Feedback loops. When markets move, reality follows. If markets crash, companies stop hiring, banks tighten lending, governments panic, people lose jobs. The prediction creates the outcome. This is the quiet trick of finance. Markets don't just forecast the future, they help manufacture it based on fear, greed, and herd behavior. Now we reach the uncomfortable math. Most people assume markets are about allocating capital efficiently. That's the public story. The hidden reality is different. Markets are optimized for speed and profit, not stability or fairness. Here's the math that rarely gets explained. If you can see the future even slightly earlier than others, your advantage compounds. You buy before prices rise, you sell before prices fall, you win repeatedly. Over time, small edges turn into massive power. Wealth concentrates, risk gets pushed downward. When bets pay off, profits go up. When bets fail, losses often get socialized through bailouts, layoffs, or inflation. This creates a structural imbalance. A tiny group plays a high-speed game. The rest of society lives with the consequences in slow motion. Markets know the future, not because they're smart in a moral sense, but because they are built to reward those who predict fastest, act hardest, and care least about collateral damage. That is the hidden incentive engine. Now contrast this with public hype. Turn on financial news and you hear confident stories. Markets are rational. Prices reflect all available information. Trust the system. It sounds clean, mathematical, objective, but listen closely and you'll notice the tension. When markets crash, suddenly no one says they were rational. They call it panic, greed, irrational exuberance. So which is it? Here's the irony. Markets are rational to money, not to society. They are perfectly logical in chasing returns. They are not designed to protect jobs, communities, or democracy. perfectly rational market can still produce an irrational world. That's the contradiction we live inside. Now, let's make this concrete. In 2008, financial markets sensed trouble in housing long before most homeowners did. Banks traded complex bets against mortgages. Prices started wobbling. Signals flashed red. Ordinary people still believed everything was fine. They kept buying homes, taking loans, building lives around the idea that prices would only go up. Then reality arrived late and brutally. Homes collapsed in value. Millions lost jobs. Governments bailed out banks. The market knew first. People paid last. Same pattern in 2020. Before lockdowns hit, markets sold off hard. They priced in a disaster before most governments even admitted one was coming. Again, the future appeared in prices before it appeared in daily life. But here's where the story gets darker. If markets always move first, does that mean they are always right? No, they are often wrong. But even when wrong, they are powerful. A wrong prediction can still create real harm. Example, if traders believe a country might default on its debt, they sell its bonds. Interest rates spike. Suddenly, borrowing becomes impossible. And surprise, the country actually does fall into a crisis. A self-fulfilling prophecy. Belief becomes reality through capital flows. That means markets don't just read the future, they actively shape it based on fear, greed, and herd behavior. Now zoom out. This is no longer just about stocks or traders, it's about global power. The countries whose markets are trusted, like the US, can borrow cheaply and indefinitely. Countries' markets distrust get punished instantly. Their currencies fall, their imports get expensive, their people pay higher prices for food and fuel. Your passport determines how markets treat your future. That is a silent hierarchy of the world economy. And then there's technology. High-frequency trading algorithms now operate in microseconds. They trade faster than human thought. To them, your reaction time is geological. They don't wait for earnings reports. They predict them from patterns in data you didn't even know existed. The future is no longer just priced in early. It's priced in at machine speed. This creates a strange world. Human politics moves slowly. Financial capital moves at light speed. When those two collide, democracy feels sluggish and markets feel unstoppable. So what does this mean for you? Not a motivational lesson, just reality. If you rely only on headlines, you will always be behind. If you assume markets are neutral referees, you will misunderstand power. And if you believe prices simply reflect truth, you will miss how much they reflect bets, fear, and strategy. The system doesn't hide itself in secrecy. It hides in complexity and speed. Here's the deeper question. If markets know the future first, who gets to decide which future they're betting on? Right now, it's mostly those with money, data, and access. Not voters, not workers, not small businesses, not the majority of people affected by these predictions. A small minority shapes the range of possible futures through capital. That is power without a ballot. So we end where we began. The market knew yesterday. You found out today. But here's the unresolved tension. If markets keep seeing first, reacting fastest, and shaping outcomes, are we living in a democracy guided by people or a civilization guided by prices? And if prices decide before people do, whose future are we really heading towards?